Moving on to our next discussion, we have Mr. Amit Nayak, Vice President and Executive Board Member, Hospitality Asset Managers Association, Middle East and Africa as the moderator. With over 2 decades of industry experience, Mr. Nayak is a key figure in asset management, private equity, and operational strategies. His commitment extends to being a member at the INFI Dubai and is on the executive board member of the Cornell University Alumni Association for GCC, along with being a board member and vice chairman for the UAERG of Federal Chamber of Commerce. Joining him on stage are Mr. Arshdeep Sethi, President, Real Estate RMZ Co, Mr. Indranil Ghosh, Managing Director and Head, Pan-Asia Special Situations, Cerberus Singapore, and Ms. Suma Venkatesh, Executive Vice President, Real Estate and Development, IHCL. Please give them a round of applause.
Good morning, or it's good afternoon now, everyone. I know that we are sitting between you and lunch, so we'll try to make it as peppy as possible. I'm sure the Marriott team has put out a nice lunch for us. Just some numbers, and I think we have seen a lot of positive story about India and what's happening. It seems, and I think it's been said quite a few times, that this is the decade of India. And I think from an hospitality perspective, you are actually seeing that move and seeing that wave move forward. Some stats, 22 over 23, $400 million has been invested into the hospitality sector. You have the government supporting it, where 1,500 crores has become 2,500 crores. So in the last 3 to 5 years, they have invested over 5,000 crore in hospitality-related infrastructure. So basically, to support all the hotels and the activations that we have. ADRs are running at around 5,500 rupees. You have a RevPAR of around 4,000 rupees. And I think the key thing is, with 140,000 keys, almost 60% plus are at around 5,000 rupees. That growth on ADRs has been something that is very positive. And going to the topic that we have been asked to dwell on is, how do we pick the right deal? So in this 400 million, I think there has been one thing that has been interesting is there have been around 22 transactions as well, which in India, transactions, hotel transacting was not ever seen. Everybody wanted to hold on to the hotels, but now you're seeing that transactions are also happening. So with all of that, we have a beautiful panel, and I think everybody can talk about what you do, some insights about the businesses that you're looking at, and give a 2-minute spiel on what would be the flavor of the offering that you're expecting for the deals in play.
Hi, good afternoon, everybody. I'm Suma Venkatesh, Executive Vice President, Real Estate and Development for Indian Hotel Company, looking after development, tech services projects, and asset management for the company. Well, IHCL has been on a fantastic growth path for the last 6 years, and we have been growing at a rate that is faster than probably any other hotel company in the country for sure, or in the region, I could say that. And for us, growth is, as you all know, we are owner and operator. We also own assets. We started off as an owner-operator, and our growth has been what we call as more asset-right rather than asset-light or asset-heavy. And our whole intention is to manage a balance between a portfolio of owned and operated assets. We are growing across all sectors in the country and all geographies. And we have not stopped building hotels. We build hotels, and we are also open to acquiring hotels, partnerships, JVs, so we are open to all forms. We also do what is called as operating leases, especially in our mid-market Ginger brand, for a Ginger brand where we take hotels on leases for a longer period of time on revenue share, where we actually share the business risk with the owner. Just in terms of flavor, where we want to go, while we are growing fast, our intention is not to just plant flags and just add numbers for the sake of adding numbers, and we really want profitable, sustainable growth. Therefore, it is important where we grow, how we grow, and with whom we grow. So we will continue to be selective in terms of markets, geographies, and partners that we work with. Our intentions of growth are not just within the country, but also internationally, and more where there is customer crossover and brand awareness and key gateway cities of the world. So, so you will see going forward more hotels being added to the portfolio, more brands probably to cater to different segments of the market, and many different innovative forms of acquisitions and collaborations with different strategic partners.
Thanks.
Hi everyone, Indranil Ghosh. I run Cerberus Capital, a $65 billion alternative asset manager in India. We've been actively investing in hotels globally and also in India. I think from an institutional capital perspective, our framework is fairly straightforward. I mean, we're trying to obviously maximize our reward and minimize the risk. Over and above that, I think what is important, I feel, for capital like ours is to be solution oriented. You know, every cap stack, every company has its own sort of path forward, and the question is how we can sort of enable that. Obviously, capital is capital at the end of the day, but if we can structure it, slot it in the right part of the cap stack, I think we can potentially create much more value than just simply sort of allocating capital. So that's really the focus, to find the right asset owners who are backed by the right operators. For us, we do want to do scale. So usually either it's, you know, work with someone to acquire a bunch of assets, or try and get into a platform that has scaled to some extent but needs external capital now to scale further and sort of capitalize on the opportunity. So those are, you know, some of the key requirements that we focus on when we look at allocating capital to India, other than the broader macro framework which everyone's already spoken about.
Thanks. Arsh?
Thank you, Amit. My name is Arshdeep. I represent RMZ Co, the president real estate there. We are one of the largest office development firm thus far, and starting last year, we decided to enter into alternative asset class, and that's where the hospitality falls in, one of the key vertical for us to really spend time on that. We've always been, I would say, a bias to looking at the hotels, because in our perspective, as you know, the old quote says that, you know, hotels are built on ego, sold on cash flows, you know. But I think from our standpoint, we always looked at from a lens of an office, where office throws a very consistent yield to begin with, versus hotel is quite volatile in terms of the cash flows, you know. But I think now we've changed our mindset and looked around hospitality more part of the mixed-use development, rather than just being a standalone hotel being done, because that's not the forte that we probably would like to go in. Also, we've seen that wherever we've done the large office development, in and around hospitality plays a very large role play. Although that's never been done by us, and it's been distinctly taken advantage by the other development firm who really finds that economic activities takes place. For example, in Bangalore, we've done one of the largest park called Eco World. We've got, it's a 13 million square feet development, which is housed best of the best client that you can name it, you know, KPMG's, Honeywell, Morgan Stanley, you know, and so on and so forth, you know. And they house what very sophisticated members, which is roughly between 100 and 150,000 square feet, you know. I remember when we gone in there in Bangalore, virtually there was no road around there, you know, and you know, we kind of took the opportunity to build the whole first tower, create an incubation space, which is what now called your co-working space, you know. And then once we build the economic activity of an office there, we realized that now there are residential and the hotels coming in there, and I'm assuming one of the part of the hotel which is held by, I think, Samis or someone else, is best performing hotel in and around there, So clearly we realize that we're creating a risk, we are rather, I would say, we're taking a risk in terms of establishing the whole space there and then have the hospitality and others verticals been taken advantage of that, which is probably the nature that we really ran it for last 20 years. But now we realize that it's important that we actually take a leap of faith, and jump in where we actually have a hospitality part of the mixed-use development, because it complements not only from a cost standpoint, but also sharing of infrastructure, and also have a captive audience to really complement that, So in our perspective, as we see, we probably would look at more of hospitality as a part of the mixed use rather than just setting up and standalone there, In fact, in few more cities that we're now looking at, which is predominantly in Mumbai and Delhi as well, again, it's a part of mixed use. It may not have the component of office, residential, hospitality, but it probably would have a component at least of 2 of the vertical that we think of. Second importantly thing that we realize is that in our business park, when we set up, we usually take 3 to 5% what we call a social space, which is predominantly the F&B, This basically caters to the captive audience that we have it in our parks because, as I mentioned, each park has 50,000 members to 100,000 members been operating, So you need fine dining, you need food court, you need, the all support social F&B required there, And we ran that business, which is predominantly which space we build the infrastructure and then lease it out to the third parties to really manage it, Now to me, hotel just not have the rooms, but also have a large F&B revenue, which is, I'm sure, we're learning that through as well, So clearly, idea for us is to see that how this whole 5% of real estate allocation that we do on what we call a social space, then become part of the whole hospitality offering as well, So for us, hospitality is just not rooms, but also an F&B and the whole social space that we're now trying to look at that. Although in our mind, the numbers don't stack, as I mentioned to you in the office side, but I think we have now a different lens to look at the hospitality part of the mixed use rather than looking at from the office standpoint. So that's the key for us.
Thank you, Ghosh. I think with the right deals that we have been talking about, one of the hats I wear is the Hotel Owners Association for the region, and it's quite a big portfolio of hotels in Middle East and Africa, over owners of around 900 plus hotels, and globally it's roughly around 2 million keys that come under it. But one of the conversations that we are seeing more and more about is about mixed-use developments. And I would like to hear from an operator and an investor, I think, or an investment firm. What do you look at it as a flavor? So somebody comes to you and offers you a single hotel entity versus a mixed use where you got a hotel as an entity of substance. How do you pan it out? What are the numbers that you look at? What is the right deal? As well, one of the things, Suma, Manav mentioned about how do we look at the GOP conversions. And one of the topics that came out is look at the IRR plus the cost of operations. That should be a minimum GOP of 26 to 27% from an India perspective, if you can curate around it.
So increasingly, we see a lot of mixed-use developments, and as one of my colleagues said, that they always did only hotels, but they saw that did offices, and they saw that the hotels that were built in and around their commercial developments really did very well, and that's what prompted them to look at mixed-use developments. But for us, the way we look at mixed-use developments is there is a whole lot of synergy and positive rub-offs to various components for every stakeholder that is involved in the development, be it the customer or the developer or the operator. Just to kind of elaborate a little more, typically when you have offices, retail, commercial, entertainment, hotels, and residences as part of one large development, is you're revitalizing actually a whole community or a whole market and creating an ecosystem where you are creating spaces to live, work, eat, play, entertain. So there is an entire ecosystem that is created from a customer point of view, and hence it makes it so much more attractive for somebody who wants to come to that city to work or to live or just to have an office space. When it comes from the developer's point of view, what it really, the way we look at it, when we invest in those mixed use is there is a lot of synergy in terms of facilities that you're creating, the back end and the support system, which actually brings down the cost at an individual component level. While the initial investment on the larger mixed use development may be higher, but the investment on creating a standalone hotel probably might be more than creating a hotel as part of a larger mixed use, because you are actually creating facilities that can be shared between the various components. What it also does is helps you plan complementary spaces and not have overlap. Like if you create spaces and you have somebody else doing a F&B, standalone F&B where you're competing headlong, then it's not going to do good to either of the components. So you're in greater control of the development on what you're going to create and what kind of price points and segments you want to really attract. It also helps in overall, in terms of cash flows. Oh, there is a fly that is troubling me here. Sorry. So in terms of cash flows for the developer, the longevity of the cash flows, typically, let's say a residential or a long stay product is more immune to the vagaries of the hospitality market, which probably hotel rooms would, change depending upon the tourist inflows. So, or the rentals that you earn from office spaces are more certain. So as a developer, you get better cash flows and you can manage the cash flows better in terms of returns on your investment. And for an operator, it just helps you in providing enhanced experiences for your guests. Like if you have a branded residence or a long stay product, you can provide, depending upon where you're located, if you're a beach resort with branded villas, you have a beach club, you have dining options, or if you're a city mixed use development, you could create very enhanced concierge services for the residents of that property or even for the tenants in the office complex. So there is a lot of interplay which each of the components and the operator of each of the component can use it to enhance the returns that or the revenues that you would earn from these components otherwise. So for us, whenever we look at these mixed use, it may not always be all components. It could be a hotel with branded residences, or it could be a resort with certain villas that are sold, rented back, and various options. Or it could be a mixed use where you have an office block and a hotel block with some retail in it. So when you look at it, for us, a couple of key things is the positioning of each of those, and that there has to be synergy. They have to be similar positioning, because it's a double-edged sword. One of the downside is that if all the components are not at similar level of positioning, you can have negative rub-offs to either of those components. So you have to be careful on how this is developed. Is it all just sold strata sale? Is it multi-ownership over the longer term? Because you don't want a developer who just sells, let's say, every floor or every 1,000 square foot space in a commercial building and walk away. Then you're left with, multi-tenanted properties or multi-ownerships, which has its own complex challenges for the rest of the development on the maintenance of the common areas and things like that. So there are these various aspects that one would look at
but
before
these are structures that through a proper management agreement and legal framework can be managed and ironed out very easily. Indranil,
so
we spoke about, so just one more thing to add to this. We spoke about if you're 100 million, I think let's make it $1 billion. If you had that to invest, how would you kind of curate this?
Yeah, so I think from a mixed use perspective, undoubtedly, as both of you have said, it does create more economic value. But the challenge for an investor is it's very often hard to unbundle the hotel, right? So if I am investing in a mixed use development, chances are that the square footage and the total value of that project that comes from the hotel is, a small portion of the overall value. So my focus is always going to be on the residences or on the commercial aspects, and a little bit diverted away from the hotel. Of course, it's going to go into the spreadsheet and there will be value. The other way to do it, just to complete and you can ask your follow-on, is you do a bunch of these, which is what RMZ wants to do, right? They have built 60 million square feet. They can have, 12 hotels, create a hotel platform out of it, and that's when it starts getting interesting. But that's a journey for any developer. So as an investor, I'm not quite sure that a mixed-use development is even a hospitality investment for me. Right? Yes, hospitality is a component. It definitely enhances the value of what we are buying. But it's a little bit of I'm focusing on the asset, which is office or residences, than just the hospitality.
On that note, is it because you don't have the data and the metrics for India? Oh. Is it an issue with the data, or is it that is the way you would normally look at the valuation of the asset?
No, not really. So if it's a mixed-use development where I'm going to come into the cap stack of the entire mixed-use development, right? Just from an enterprise value perspective, chances are, obviously there are examples of, the hotel being more valuable than everything around it, but, chances are, the office will need more capital and will also be, in terms of dollars, just more valuable, right? Which is why as an investor, I'm going to focus a lot of time figuring out whether that IT park is going to be successful. Branded residence is a little bit different. It's obviously, the knock-on effect or the halo effect of the hotel brand is what's selling the residences. Again, the micro market is going to be important there in terms of, how much, like if it sells at X, can I get a 20%, 30%, 40% premium, and what does that mean for my economics? But again, a large chunk of the cash flows, for at least from a de-risking perspective, is going to come from the residences. I'm going to be focused on what that micro market is from a selling the residential asset perspective. So it makes immense sense, but as an investor, it is a little bit more complicated. Takes us away in certain cases, I would say, and especially in city center cases, takes us away from, the hospitality element, and we tend to focus a little bit more on the other elements.
So one of the things that we've been talking about is F&B. The halo effect of F&B, we have very few restaurateurs running F&B in hotels. We have hoteliers running F&B. One of the key aspects also what we have seen is that there are quite a few business cases of restaurateurs and restaurants globally where the restaurants make more money than the hotel itself. Is that something that in any of your business cases, whenever you're looking at the right deals that you've looked at, F&B, you said you have got 50,000 members in some of your business parks. Is the right F&B the right deal?
So 2 comments I'll make. I'll probably go back to the topic that we just discussed and bring about a bit of a dichotomy, if I say it. Unfortunately, the business that we ran thus far produced the highest yield, but it does not commensurate with the kind of valuation which likes of IHCL really enjoys on a market. So we have a bit of a dichotomy where we perform well, but we don't value well. And here is something which is a long-term asset where what's the value to be really arrived at? It's anyone's guess, because other than the listed data, not many transactions happen in our country, and I'm specific to our country. And again, you can bring in Middle Eastern and other part of the global world that really you deal with, But on this side of business, you don't see really many a case study which talks about that on a private transaction, an EBITDA multiple 30, 40 is being considered, It's never been, when you go to any consultant, they'll look at the DCF, discount it back, and then they'll whack you with the WACC which is required to be really put in, and no one really then consider the whole listed valuation been trading at. So I think the point I was making on this, and I know I'm going back to the previous topic, from our standpoint, we're trying to see how we can minimize the risk, rather than fighting on this valuation game, which I think is not in our hand, because if EIH, IHCL is being valued to a market because markets see them for good reason that they are, EBITDA multiple as high as, I'm sure, 30, 40, 50, which is never case in any asset classes. But when you go look at a hotel to be traded at, you probably won't get a 5, 6 cap rate. You'll still get all those numbers that we can talk about. Mostly hotels are being sold when it is in distress. We haven't seen performing hotel being sold. Usually you take over stories are there. So from our standpoint, when we look at any development and a mixed use, we're trying to see how we can set off the cash flows of other asset class into the hotel, which means when my hotel is built, I probably have a leverage maybe as low as 30 or maybe 0, which means when when a market hits any shape that you call it, it's more volatile, pandemic, no pandemic, and EBITDA goes down, I'm in negative trading on that. I have nothing to then to really responsible to chase up and say, look, I need to owe a bank money of leverage of 40, 50% on that. So I think in our mind, the reason that we're looking at this whole switchover or this set off is because of this dichotomy, because as Manav also mentioned today morning, that party is going on, 3 years back, same operators that we used to meet up with, they said, look, can we do a partnership with you? We asked them why, because they said, look, at least office perform a stable income,
Okay.
Versus today is completely different because of the reason best known to us. So there is a cycle to everything. Coming back to on the F&B side, we are very clear, we are a owner and not the operator, We want to build, own the asset, and have the best partners to really manage it, We're not trying to be a IHCL, we're not trying to be EH, because they bring 50, 40, 60 years of history of having ran hotels, seen multiple cycles, ran F&B, standalone, part of the hotel. So they've gone through the whole, I would say, turmoil and the good times on that. So from our standpoint, partnership is a model that we look for. We build the infrastructure, bring in the best of the best F&B, social, and hand over the business to them, Then it's their outlook, and then the relationship could be a revenue share basis or a lease basis.
So talking about what you mentioned from a valuation perspective, and Indranil, your points about looking at development, a mixed-use development where the hospitality part is not valued to a point. So I think you do not have enough of listed entities of substance from a hospitality perspective in India to actually benchmark it. But listening to what he's saying, actually having a hotel in your mixed-use development actually creates more value for your exit.
100%, which is why I started by saying that there is a lot of economic value that gets added, but just as an investor, right? I am just distracted by the other offering that mixed use, produces or gives, that because a large chunk of the value in total terms kind of sits there. Now, to the point of 30 times, 40 times for some of the listed comps, again, there are various kinds of listed comps, and I think, this is a great year. A lot of people are raising equity in the capital markets, follow-ons, and as well as IPOs. So I think we will see a much bigger comp set from a listed perspective. And originally, IHCL, Oberoi, etc., the one distinction to make versus, maybe what Arshdeep is saying, a standalone hotel, is that they have the brand. And their multiples, while maybe elevated, I wouldn't comment on it, but if you have to look at their ROEs or ROIs, are significantly superior than what a standalone hotel will create. And at the end of the day, that's how multiples work, right? If you have a better return on your capital, you are obviously going to get valued higher. If you're an asset which can only generate so much GOP or EBITDA, then you're going to get valued at a cap rate, which is not going to be 5, because as a allocator of capital, if I can get an office asset at an 8 cap or a warehousing asset at an 8 cap, I don't honestly, there is no vanity in owning an asset which is hospitality for us. All we care about is how the numbers solve. So single asset needs to be treated more like, single asset peers in real estate versus a platform with a brand. Platform is, deserves a multiple because it's more de-risked, even if it's just asset platforms with a global brand or a local brand, and then brand owners obviously have, an edge.
I think I'm happy you touched on it, because some of the things that we are working with are REITs. So we are looking at hospitality-focused REITs where the platform is there, the investment, and because of the multiples that we see on the real estate side and the branded hospitality side of things, we are seeing more and more interest in that. On that note, Suma, if you're looking at creating value for the right deal, how does a Taj, if somebody wants to invest capital into a Taj branded asset, how does Taj from an asset management point of view, development point of view, and operator point of view, how do you create the right deal?
So the first and foremost is, I think, coming from Taj, coming from IHCL and from the House of Tatas, we really stand for trust, right? The Tatas for trust. So what we really bring to start with is even plain to start a stronger, longer-term relationship, and nothing is, looking at every quarter returns. We believe in looking at every relationship more longer term, creating sustainable longer term value for all the stakeholders. So that's number one. The other thing for us is, as we are the strongest and we have the strongest brand, Taj has been voted the strongest hotel brand in the world by Brand Finance for 3 years in the last 4 years. So we are a brand that has already demonstrated that we bring in huge value to whoever works with that. The third thing is, as a company, being an owner operator, what we really bring to the table is the understanding of what it takes to develop a hotel and what it takes to stick to brand standards and operate a hotel. And I was just told that yesterday there was an owner's session, and I was told that good there were no technical services people within the room, otherwise the owners were very upset on the way the tech services approach these developments and look at it only unidimensionally from the brand and the brand standards point of view. And when I meet some of our potential owners, what I really bring to the table is our understanding of both the pain or the challenges of building a hotel and what brand standard stands for. And probably we are one of the few companies in the world that are organized in a way where a person like me looks at not just development and signing deals, but technical services projects, construction. I run a construction team where we build hotels, and I know exactly what could be the possible challenges as you go along when you build hotels, and also asset management, which I have taken over 6 months ago. So there is a whole range of experience that we bring to the table, and the conversations are therefore very different. And the flexibility that we can bring in during planning stage is very different from somebody who just looks at it from, a set of standards that you give to the owners. And what is really important is all these investments, when you make those decisions to invest, are based on certain projections and understanding of the market and what rates you would get and what demand you see. But the truth is, hotels take a good 3 to 4 years to build, and things can change in those 3 years. So the projections are all conjectures in the future. What is certainty is what you spend today in building that, right? That is certain, that you do that immediately. So it's very important to control what you spend, how you spend, and how much you build for the right brand and for the right segment in the market. And for us, I think understanding that part is really the biggest value that we bring to the table to our owners when we approach to make it feasible for everybody who is involved in that development.
And I worked with Taj enough, so very much endorse everything that you're saying. Arsh, from your point of view and your office space, but now you're moving into hospitality, what are you looking for? What is the right deal for you?
So 2, 3 things. One is that it's an asset diversification strategy for us, I think that's one which is very critical. Second, I mentioned to you that hotel as an asset class is very, very attractive, although it has different dynamics of it, but I think in a long run, the value that you create on a hospitality, I think something is non-replaceable. I mean, you got Suma sitting out there, and she knows there are certain properties that build. I mean, there is no alternate to that. They own it, and they own it forever, and to me, it's been last 30, 40 years, and next more decades to continue, and then they can keep, reshaping it, repurpose it, or whichever way that they want to do it, But I think clearly those become a very powerful destination, and the replacement cost is very difficult to arrive at. And I think there's a mind shift from our standpoint that, this is not a real estate, If this is a real estate, then it comes back to the same dynamics that we talk. This is a more game plan that you need to have more bandwidth of hanging around for 10, 15, 30, 40 years, but which is a similar philosophy that we have in office, But out here is that value creation happen as we go along, So that's one. And third, as we go along, and I'm sure we spoke with previous panel, India is rocking, you know. I mean, the fact is that GCC on the office side is coming in a big way. Resi, everyone who's into it can see it. Hospitality data is evident, you know. I mean, today, you go to any hotels around, you know, they have repriced it already, you know, in spite of having done nothing on the property, you know. Sometimes you really feel, I would say, not so excited about it, but you suddenly realize that last year I was paying $150 and now I'm paying $300, you know. For what for? Nothing. Nothing has changed, you know. What needs to be done, and I think moving forward is how do you bring sustainability and the whole serviceability, you know. So I think that's something which needs to be looked upon. So from our standpoint, clearly is a diversification, and we value this asset class very, very, very well. And from our standpoint is to build a portfolio along with this. I'm not fully averse to having only just being this is part of the mixture. The idea is to have standalone as well. But I think the idea is to see that how we can make sure that my financials has a low leverage to the hotel when it is built. I think that's the key for us, you know, which is where Indranil may appreciate, because when an investor comes in there, if I create a scenario like this, you know, he'll be more apt to look at those opportunities rather than having a high leverage being done on an asset class, you know.
I think on that, in the interest of time as well, I want to check one last thing with Indranil is when you are working with or looking at investing into a real estate asset class and where hotel is there, and you spoke about having the right brand or partner. Just a quick 10-second thing on what do you mean by that and what are you looking for?
I mean, again, it's what both of these guys said, right? The ability to execute on ground in terms of the development, meaning find the light land parcel, get the permitting, as we just spoke about, 100 permits, get it built, and then, you know, for someone like IHCL to move in and just, you know, create value.
Does the valuation of IHCL matter?
Well,
from an exit perspective?
Sorry,
from an exit perspective, does the valuation of the brand matter?
Not that much, because at the end of the day, the brand is owned by them. So if we invest in a particular asset, we really look at that asset's cash flows. And the value that the brand has is extracted by the brand through its various cash flow streams. So,
okay, thank you. I think we have a few questions. So one is target returns and payback period for a new hotel versus acquisition. You want to pick it, Suma?
Well, the target returns would really depend on who is investing and what your cost of capital is. But I would really say return on an acquisition definitely would be higher, provided you can acquire it at a price much lower than its replacement. And the risks, and you don't have the risks of development, right? Because you don't have to invest and build the properties. Today, I was just reading a JLL report, and last year, 2023, has been the year of maximum transactions that have happened in the country. 21 transactions, of which almost 5 or 6 deals have been through liquidation process, so those were really good deals. Then 5 projects under construction, that is, and some greenfields. So I think in terms of return expectations, acquisitions do provide you better returns than going in for a greenfield development because of the complexities involved in developing a greenfield project. However, finding the right asset which fits into a particular brand or a segment is the key here, and acquiring it at the right price. I think that's the challenge. But if you can get it, that's fantastic. You should go and buy more.
Arshdeep and Suma are the ones that all their questions are targeted to. So, Arsh, which tier 2, tier 3 markets are attracting you today?
There are 2 questions to that. One, my views on the tier 2, tier 3, although we are believer of those tier 2, tier 3, however, our investment philosophy has nothing to do with the tier 2 or tier 3. We want to be focused on tier 1. There's enough business being done on that. The reason that I'm saying it because we realize the capital value appreciation is far greater in those versus having to take a risk in tier 2 and 3 cities there, you know. And again, this is our views. I'm sure, you know, other institutional players have large in-depth participation.
I think just to add to that, in a country like India, the airlift capacity that has come up
Yeah.
in those tier 2, tier 3 also play a major role.
That's right.
Because what we saw in the STR report as well, one of the key factors was the airlift, and we have seen that. I live in Dubai, and the beauty of Dubai is the beauty of Emirates.
That's right.
Yeah. Thanks to Emirates, we have such beautiful airlift globally that we just have to build, and we always have traction that goes with it. One of the questions is any new age metrics that we use to track hotel returns. I can speak about it from an asset management perspective. Is there are metrics, but there are horses for causes. You can't have the same metrics for everything. So if there is a leverage, there is debt, the metrics are different, because then you're looking more on below the EBITDA line than anything else. If you don't have any leverage, like some of the big family offices here, and debt is pretty new to the Indian market, your metrics and ROI are very different. So so it's different for every asset class, and I assume, Indranil, I assume you also agree on that.
Agree, yeah.
Very different on that. What is your most preferred asset class of hotels? Oh, it went. Okay. What is of hotels from a return on investment perspective? Indranil?
Sorry, what's the
with
question?
that?
I can't see it. What is your
Most preferred asset class of hotels. So I think they mean by lifestyle, budget.
Or maybe office, commercial, retail, maybe that's what, and
No,
hotels.
no.
He's
This
already
is only
said-
for hotels. You don't get to choose anything otherwise.
I think for us, we would allocate capital to any platform or any asset that is just profitable and is being run and developed by the right partners. So I think that's
So I think I even subscribe to that. Is every type of asset in a hotel class is very much related to where you are and which brand, because somewhere we have seen, I think, all across India and even outside, there are some amazing brands, but they got the wrong location, and they were not able to deliver, and then that becomes the reflection of the brand.
I mean, obviously, on our wish list would be diversification, which is why another reason why IHCL trades where it does, because it has everything. So leisure, business, whatever. So
I think here IHCL open for mixed-use projects with branded residences. I think the answer is yes. Yeah.
Yes. we are looking at, and we'll soon be launching our first mixed-use development with hotel and residences soon in Chennai, and there are many more to come also in the leisure space. So there will be.
I think minimum IRR that's popping up a few times. I think the minimum IRR is again subjective to where, what, when.
yeah, I mean, and going back to the previous question as well, right? Like Suma mentioned, if you're doing greenfield, you're taking a lot more risk. And you've already deployed capital, then you would obviously expect much more. Again, whether it's equity, debt, all of that sort of matters. So yeah, it's
I think perfect. On that note, thank you. I
Thank
think
you.
it was an amazing panel, and I think out for lunch now.
Thank you very much. Thank you. Thank you. That's very good.
Thank you, everyone. That was a wonderful session. Before we break for lunch, I'd like to remind